Hi, this is Axel. I'm the President and Chief Investment Officer at Merk Investments with the latest chart book on the US business cycle. I'm recording this on Monday, March 11 in the afternoon after the market closed, ahead of our Wednesday release. And as always, Nick prepares these. I give my take of in between the line readings. Go to merkinvestments.com/research to download the PDF. So you can study these charts in more depth. I'll highlight a few things in here. Again, for those newcomers, it is important to look at the business cycle simply because, historically speaking, the stock market has performed far better during economic expansions than during recessions. Forecasting recessions, some people say, is very difficult. We believe that it is possible, maybe not perfectly, but we are looking at a consistent set of parameters here. And with that, we hope we can be a tad more assertive about when the recession might happen. And that may, depending on anybody's investment process, portfolio construction process, have implications. And that's why we think there's value in looking at these things. So in that context, leading economic indicators have come down, but are clearly still in expansionary territory. A lot of talk has been given to the steepness of the yield curve, and indeed so much so that several folks at the Federal Reserve have started to pay very close attention to it. The yield curve inversion is I call it a necessary but not sufficient condition for a recession. Clearly, there's always in the past a recession has happened at some point, but we've had false signals. Also, let's keep in mind there's a reason why the Federal Reserve historically has continued to hike rates and then induce the recession. It's because inflationary pressures usually had been rising. And so it's not as if that whenever the yield curve is at risk of inverting that they have to back off. Now, clearly, the current Fed Powell does not believe inflation is a problem. I phrase it that way because of some other context I'll give you in a second. And PMI here in the US is in expansionary territory. It's ticked down, manufacturing PMI, but is in expansionary territory. Noteworthy, however, is the global PMIs. Several of the large economies, China and Germany in particular, also Italy, below 50. And we've had, I believe it's, if I'm not mistaken, France had been dipped tad below 50, is back above, but still headwinds have increased in the rest of the world, and there is no doubting of that. I have pushed for a long time, especially in Germany, saying, hey, the headwinds are temporary, changes in emission standards that has prevented cars from being produced, and I stand by that. I think those are temporary, but as Draghi, the head of the ECB, has pointed out, there are so many risks out there that are all on their own merit probably have a good resolution or have a good chance of having a good resolution, but it has started to impact sentiment. And so I can nice talk the German economy all I want. The PMI here is below 50. By the way, those issues on manufacturing and the automotive sector continue. They're still working through the kind of the issues of not just having the equipment ready to test everything. There's still a backlog on that. And then obviously there are headwinds from trade and Brexit as well, potential ones. And then in China, and let's just touch base here on China. The Chinese have been doing a lot to try to stimulate the economy. The recent economic numbers have not been good coming out of China. But the question really is, are we maybe at the tail end of this issue or not? And the one caution I like to give is that some people say, hey, there's a trade deal, everything is going to be dandy again. An increasing number of people are pointing out that the so-called trade deal is likely going to be an incremental one, meaning that the US is going to reduce tariffs as they are satisfied and get satisfied that the Chinese are taking a step closer towards adhering to the sort of things Americans want. If and when that trade deal is going to happen, I don't know. But in the meantime, the Chinese are doing things to stimulate the economy. They're not cutting interest rates, by the way. And indeed, I think there's increasing chatter that they'll strike a deal on the currency management. And I've been a bit of a critic of that quote-unquote deal, because any deal to manage the currency, almost by definition, moves away from the goal of having a free-floating rate. And the reason why the Chinese have lower rates is precisely because they don't want the currency to plunge. They've done all kinds of other tricks they've tried to pull out of their hat, including most notably reducing reserve requirements. Not the most effective way, by the way, in my view, to kickstart an economy. And the traditional way of jumpstarting an economy, infrastructure spending, is something they're reluctant to do. So they do other things. But actually letting the currency plunge might not be a bad thing. And in my view, that would be in the interest of the Chinese. But it doesn't matter what I think. PMIs are below 50. Then, I hope I didn't lose you guys. I just had an issue here with my screen. Let me see whether I can continue here to the next page. Let me try it this way. Here we go. Job gains. We had a non-farm payroll report that only generated 20,000 jobs. And that was considered to be, well, negative. If you're an economist, you look at the 3-month average, and that looks just fine. And so the question is the economy falling off a cliff here? I don't think so. I think this number might be a fluke, especially since it's not consistent with other data. But you never know, right? The fluke can become a trend pretty quickly, and by the time it has become a trend, maybe we have fallen off the cliff. The 3-month moving average is just fine. And again, one should look at these numbers in context as to and how to position them. Then also related, obviously, the unemployment rate, the U3 rate, the broadest, the most commonly known measure, has ticked back down, and we put it in the context here of this 12-month moving average. Remember that last month there were several distortions, and I think some of them are trickling through to this month based on the government shutdown. And so we're below this line, and from that point of view, yep, again, end of economic cycle, but not at the recession level. There are other models here. I'm going to skip this line. And then the Congressional Budget Office has its own models. I am not too much a fan of those, and as you can see, they can go way overboard. But in any case, they don't suggest we are nearing expansion. The same with the output gap. Atlanta Fed GDP now, that's a quote-unquote real-time index, close to real-time index that suggests where economic growth is, and you see there's a very high correlation where it actually has been, and clearly in the short term, it suggests economic growth comes down in the US as well. And of course, if you put that in the context where the market had been, the yield curve at the very near end is very flat. And what I mean with that is, if you look at interest rate expectations for the coming months up to a year out from now, it is extremely flat. On a risk-off day, the market is pricing in that we've reached the peak in the interest rate cycle. And other days, it means that we are only reaching the peak in December. But we're really talking about tiny fractions of percentages. And so we're currently expecting, right now, as I look on the screen, the peak at the Fed funds rate is expected to be in March at 2.4%. It's currently already at 2.4%, right? The 3-month LIBOR rate, a tad more driven by the market, is currently at 2.60%, 260, expected to be at 2.63% in December. So we're really talking here tiny, tiny differences. And what I'm trying to say here is that the Federal Reserve is currently not pricing in any rate hikes. It's pricing in things going to be flat. My own take is that inflationary pressures will increase. And with that, the Fed will be bound to hike rates later this year. In that context, I heard a commentary on Bloomberg Radio this morning saying that, yeah, well, these inflationary issues are not a problem until they are, right? You are kind of in a box if you have enough people on the side that come to the labor force. But if you breach that threshold, suddenly inflation can become an issue. And that's exactly what I've been preaching and been concerned about. Credit cycle. This chart of the credit cycle, which is mostly focusing on the mortgage market, is just fine. Obviously, we're close to that longer term. It's 3 moving averages. It's closer to breaching that. If you look at some more sensitive areas of consumer debt, there you've seen some spikes, but it hasn't managed to make it over to the mortgage market. Overall, the consumer is healthy. And so, again, consistent with late stages of this cycle, but those late stages can last a while. Consumer confidence is doing just fine. And again, the consumer is doing just fine. And what that means is that, to me, in an economy that's mostly driven by consumer spending, it's difficult to imagine, even with all the cautions we have around the world, that we'll dip into a recession soon. Lending standards, tighter landing standards suggest here an uptick in these lines, and nothing too concerning here. And indeed, there are other measures of tightness in credit. There's a high yield spread, and well, I don't think we have it here. Let me go back here to this one then. There is the Federal Reserve has a measure of, going back again, no, we don't have it here, of senior loan officers, which suggests that lending conditions are as light as they could be. And so clearly the Fed has done a U-turn and said everything, well, even before that, lending standards were very, very light. But in the context of a very low unemployment rate, of wage pressures that are at an annualized rate of over 3%, we don't show that here on these charts. I wonder whether it is prudent to have super easy credit standards in the US, and Powell certainly thinks so. And building standards here, building permits have come down a bit, so that's at risk of tipping over. And here's a summary. So the reason why the Fed tightens, just to make that clear, is so that we don't unanchor inflation expectations, so inflation does not become a problem. And clearly inflation hasn't been a problem for a long, long time. I've heard the term Goldilocks though several times in the media, and that we have good growth, wage growth, but inflation is low. And the concern I have with that is that usually when times are best is when you want to prepare for something that's not so great. Ahead of the financial crisis, we also had a Goldilocks economy, and I'm not suggesting we're heading into a financial crisis, but I am just very skeptical that we can let this economy run at the with interest rates still being at the Fed what calls the lower end of the neutral range, basically giving still a boost to the economy. And we'll see. We'll see in a few months whether this was warranted, my concern, or not. But I would think because of that, they'll have to at some point play catch up and continue to raise rates. In any case, here is Nick's summary. And please read that, read it offline. And by all means, please don't forget to read our disclosure. Come to our website. And by the way, just you also see here, I don't know whether you can click it in the video, you can come to Merk Investments /research and also look for our advisory services if you like to help us to help you to make sense of what this means for your specific portfolio. We can't do that for everybody, but we're slowly trying to ramp that up to have the capacity to take on more people for whom we can do this. In any case, give us our feedback. Thanks for listening, and talk to you next time.